You've heard people bragging about stock gains or panicking about crashes. Maybe you've seen someone turn 10,000 into 50,000. But here's the question most people are too embarrassed to ask. What even is a stock? And how does buying one make you money? Today we're breaking it down simply. No jargon, just truth. Let's go. What is a stock? A stock is literally a piece of a company. When you buy stock, you own part of that business. Think of it like a pizza restaurant, divided into 100 slices. Each slice is 1% ownership. Buy 10 slices, you own 10%. If the restaurant triples in value, your slices triple too. If it struggles, your slices lose value. That's stocks. Companies divide themselves into shares. When you buy shares, you own part of that company. More shares equals bigger ownership. Why would a company give away ownership to strangers? They need money to grow. Building factories, hiring employees, developing products costs serious cash. Companies can borrow from banks and pay interest, or sell shares to investors and keep that money forever without repaying it. When a company sells stock publicly for the first time, it's called an IPO, initial public offering. This is when private companies go public on exchanges like the New York Stock Exchange or NASDAQ. The company gets cash to grow, investors get ownership in a hopefully successful business. Let's understand through coffee shop example. Meet Sarah. She needs $100,000 for her coffee shop Brewhaven, but only has $50,000. She divides her business into 1,000 shares, keeps $500 for herself, and sells $500 at $100 each. Alex buys 100 shares for $10,000, giving him 10% ownership. 3 years later, Brewhaven thrives. The business is now worth $500,000. Alex's shares jump from $10,000 to $50,000. If he sells, he makes $40,000 profit. But what if a competitor crushed Brewhaven and the value dropped to $60,000? Alex's shares would only be worth $6,000. He'd lose $4,000. This is stocks. Values rise when businesses succeed, fall when they struggle. You make money two ways. First, capital gains. Buy a share for $100, sell for $150, pocket $50 profit. Second, dividends. Some companies share profits with shareholders through regular cash payments. Growth companies like Tesla reinvest everything. Established companies like Coca-Cola pay steady quarterly dividends. You profit from price increases, dividend payments, or both. Common versus preferred stock. Common stock is what most people buy. You get voting rights on company decisions. More shares equal more votes. Common stocks have highest growth potential but higher risk. If the company bankrupts, common stockholders get paid last, often nothing. Preferred stock has no voting rights, but you get priority dividends. Payments are fixed and reliable, paid before common shareholders. In bankruptcy, preferred shareholders get paid before common ones, though still after debt holders. Preferred stock is safer and steadier with less growth. Common stock is riskier with bigger upside. If stocks are making sense, hit like and subscribe for clear finance videos. Comment, are you already investing or just learning? Why risk money in stocks instead of keeping it safe in a bank? Growth potential. Savings accounts pay 2 to 3% yearly. Stocks historically return 8 to 10% annually long term. 10,000 in savings at 2% becomes 18,000 in 30 years. The same 10,000 in stocks at 8% becomes over 100,000. That's compounding higher returns. 3 beginner tips. First, invest in companies you understand. Don't buy because someone on social media said to. Second, diversify. Spread money across multiple companies and industries. If one fails, you're not wiped out. Third, think long-term. The market rewards patience. Buy quality companies and hold for years or decades. Bottom line, stocks are company ownership. You profit when companies grow or pay dividends. Common stocks offer growth with risk. Preferred stocks offer stability with less growth. Stocks historically beat savings by huge margins. Subscribe for more finance breakdowns, hit like, and share with anyone confused about investing. Comment, what company would you invest in first and why?